As you know, private credit is it's mushroomed to become one of the hottest, if not the hottest, sort of alternative investment in recent years. So I'm excited to have a conversation today with someone who is, I consider to be an expert in this, who is Akila Grewal, who is a partner at Apollo and also global head of credit product there. And she was named a partner last year. And she is what I like to call one of the evangelists of private credit, going out spreading the word about why and how this can be used as an asset class. Now, what interests me particularly about this is that private credit has sort of taken over the headlines, but I still consider it to be sort of a misty area for a lot of people. So I'm glad we had this conversation to talk about a little about it. Now, although the estimates say that, we're talking about a, $1.7 trillion business now, I still think that a lot of people are sort of new to this. Are you finding when you're talking to companies and investors about getting involved in this that there's still an educational process?
Yes, absolutely. There is definitely still investors who are, getting educated on what private credit is. I think you heard earlier, when we say private credit, when we say 1.7 trillion, we're really talking about mostly a direct lending kind of market, right? And that is sponsor-backed lending to small companies, as you heard kind of on the prior panel. At Apollo, we think of private credit in a much broader definition. We actually think it's a $40 trillion addressable market that spans everything from investment-grade fixed income through to asset-based finance, through to sub-investment grade opportunities. And so when you talk about education, I think our mission has been really to educate investors about how private credit can actually permeate throughout your entire portfolio and really have a place across, a portfolio. And that has been the education as well as the listening piece that we've been a part of.
Now, when you're talking to, I don't know, whether it's, an insurance company, whether it's a sovereign wealth fund. I mean, when you're saying, you ought to have us as part, or you at least ought to have private credit as part of your allocation. I mean, what's the big draw for them? Is it yield? Is it diversification? Is it the idea that they don't want correlation to other assets in the portfolio? Or does it vary depending on who you're talking to?
I think it varies, but I think generally speaking, when you're talking about, there's a lot being said about private credit being a very large asset category. Is it a bubble, et cetera? I think when you think about private credit, on the other side, you're talking about public credit or public markets. And public markets are actually much more correlated, much more concentrated, and give less diversification for an investor when they're thinking about getting diverse sources of income, diverse sources of return, and diverse sources of ultimately correlation within their portfolio.
Well, one of the things that a lot of traditional investors, though, particularly like insurers that may be new to this, one of the things that we've heard is that a lot of them worry about the lack of transparency and also the idea that, that there's a questionable secondary market for a lot of these, which makes them sort of like have to think harder about this. How do you respond to that when you're talking to people who want to consider it?
I think that, to your point, the lack of transparency that might exist in some pockets of private credit is not necessarily the standard. And I think it's about making sure that you're being transparent on price discovery, you're being transparent on sourcing, you're being transparent in terms of what these assets are being marked at on a frequent basis. And I think that as the private credit market continues to grow, as it becomes more and more established day by day, which we are seeing, you will see a market over time, right? You will see much more transparency, which will allow investors, I think, to gain additional comfort when it comes to investing in the asset class.
Well, this asset class is really sort of it's mushroomed. Now we're in a different environment now from a macro standpoint and from an economic standpoint. I mean, interest rates have really changed, and does that change the attractiveness of going at this, particularly, well, I'll come to the banks next, but for us from an interest rate standpoint, does that make people sort of reconsider, or at least think differently about this?
I think generally speaking, you've seen a lot more interest in credit as an asset class, generally speaking, because of where interest rates are. Now, as mentioned previously, that doesn't mean that you can just layer on higher and higher coupons, for example, for companies to be able to bear. So what we try to focus on in private credit is still high quality, top of the capital structure, but you're getting paid, I think, significantly now, given where rates are, and you're getting compensated for, additional risk in that regard.
Another thing that's happened recently that I'm wondering how it's affecting you is, banks, which had gone through a period of trying to unload lots of things on their books, are now seem to be much more interested in lending again, and including to some of the types of businesses that would have sought private lending. Is that more competition now? Are you seeing that, and how do you combat that?
Yeah, I think that the banks have been great partners to the credit market and the private credit market. Obviously, it ebbs and flows in terms of their activity based on the markets, based on idiosyncratic events that they might be facing. But I think that, their activity, their participation only continues to bolster the broader market. And so we view that not necessarily as competition, but as a partnership when we think about, providing these types of financings, broadly speaking, to companies. And again, when we talk about private credit, we're not just talking about going to one company and giving them, X billion-dollar loan. We're talking about doing that plus providing them an investment-grade financing, plus providing financing against their real estate portfolio, thinking critically about how they might do inventory finance. So having the full suite of options when it comes to providing credit, we think is going to be the better place to be so that you can pull from different diverse sources.
I mean, as we hear a lot of people, as we heard in the previous session, who are saying, there's been so many people who've run into private credit in recent years, but wait until we see a full cycle. Or is there going to be some washout? Is there some fear there?
I mean, yes, I think that we haven't seen a full cycle yet as it relates to, new entrants to the market who haven't been cycle tested. So I think it just, again, underscores the need to be very critical in terms of the managers that you invest with, as well as making sure you're very clear in terms of where you're attaching in a capital structure and the type of risk that you're taking, in various market conditions.